Hey guys, welcome to another lesson of accounting. We are still looking at companies, and in this video, we're going to be looking at ratio analysis and interpretation. This is a section that is quite challenging in accounting because it requires a lot of opinion, and there's no right or wrong answer for most of the questions. So it requires a lot of thinking from you. So you really have to understand the ratios, whether it's liquidity, whether it's solvency, whether it's gearing. You really have to understand how all these types of ratios work and be able to apply them to each of the situations. I've actually already answered the question, but I was not happy with the sound of the video, but I still have my answers here. So what I'll be doing in this video is I'll just be going through my answers as I read the questions, but I'll also explain how I went about reaching the answers that I reached into. Yes, so without wasting any further more time, let's dive in. So we are answering question 4.3 of this paper. Question 4.3 of this paper is based on two companies, which is Castro Limited and Ronco Limited. It says there you're provided with information relating to two companies, and then you're given some background information. They say Henry Harris owns 300,000 shares in each of the companies. And then they say Castro Limited issued 200,000 new shares only to existing shareholders. Note that it's only to existing shareholders at an average issue price of R9.10. These funds were used to establish a new branch, so that's also important. Maybe they might ask a question about how did the issue of shares affect the business, and then you need to be able to see what that branch managed to do for the business. And then they mentioned there that no new loans were raised. Cool. And then they say there Ronco Limited paid 4,800,000 to the purchase 320,000 shares. So if you divide 4,800,000 by 320,000 shares, they actually paid 15 Rand per share. So let us go into the questions. So just before you get into the questions, they have a big note there. They say, where comments or explanations are required, quote financial indicators and figures to support your answer. Whether they put this note or not, always quote financial indicators and figures to support your answer as much as you can, as much as you possibly can. Because if you don't quote financial indicators, you lose a lot of marks. You should be able to, because most of these questions are about your opinion. And if you're making an opinion, you should be able to support it. And I would really recommend that you guys try your best, because a lot of people, what they do when they come across these questions is that they leave them blank because they want a question where you have a right or wrong answer. But this is actually great that you actually are required to think a little bit out of the box, and then someone can say no to something, and then there's someone else can say yes. But if they are both able to support themselves, then in that case they will be able to both get full marks of it. So please take advantage of this and try and apply your own thinking as much as you possibly can. Cool. So the first questions are based on Castro Limited, 4.3.1. Comment in the price of R9.10. So they did mention there that that price was an average issue price. So they said comment in the price of R9.10 charged by Castro Limited for the new shares issued. So in order to comment, you need some context, and in order to get some context, you must get the financial indicators and ratios. So so we know we're dealing with Castro Limited. The average issue price is R9.10. They didn't have a repurchase, so they didn't pay anything for a repurchase. The shares are trading at 12 Rand in the JSE, and also the net asset value per share, which is the true value of the shares, is 10.73, but they issued the shares at R9.10. So my comment on this, the way I see it is that if they had issued the shares in the JSE, they would have managed to raise more capital because they would have sold each share for 12 Rand. And also, I think they were a bit easy on shareholders here, because if you were maybe selling to shareholders, you'd sell to shareholders at least at their NAV, net asset value per share price, which is 10.73, but they sold below that. And this is what I had as my answer for this question. So my comment is that the shares were issued at 910 per share. Castro Limited would have raised more capital if they issued the shares in the JSE. So that is the first part. You see, I haven't quoted anything there because when I put 910, that is already in the question. And then in the below line, that's where I start to support my statement. I'll say shares were issued at below market price, which is 12 Rand per share, and below their net asset value per share, which is 10 Rand 73. So they had the opportunity to raise more capital, but they decided to sell to their existing shareholders for 9 Rand 10. Cool. And then question 4.3.2, they say, explain how the issue of new shares has affected the financial gearing and risk of Castro Limited. So when we talk about financial gearing, they are mainly referring to in terms of like the capital structure. The capital structure of the business is obviously non-current liabilities as well as shareholders' equity. So we want to see, what we want to see is how is the gearing? Are they using a lot of debt or are they using a lot of equity, and by how much? So we need to check firstly we will need to check the debt to equity ratio. So if you look at the debt equity ratio, which is the first ratio here, the debt equity ratio in 2016 was 0.8 is to 1, and then in 2017 it is 0.5 is to 1. That means that in 2016, for every Rand that Castro Limited had in equity, they also had 80 cents in liabilities, in non-current liabilities. So that was a little bit high, but since they issued, so in the current year, they issued more shares. In other words, they raised more capital. So if they raised more capital, they managed to reduce their debt equity ratio, because they also mentioned that there were no new loans that were taken. So this looks a little better for me, that the debt equity ratio is improved from 0.8 to 0.1. So the financial gearing of the business has improved from the previous year. The debt equity ratio improved from 0.8 is to 1 to 0.5 is to 1. But secondly, as we said, that the capital structure of the business is set up by shareholders' equity, and it is also set up of shareholders' equity and non-current liabilities. So it's also important to analyze what is the return on the total capital employed, because the business employs different types of capitals. They employ the shareholders' capital, but they also employ the capital that they get from financial institutions. And when we look at the debt equity ratio, we also need to look at the return on total capital employed and see how much return are we getting on the capital that we have raised. So if you look at a percentage return on total capital employed, it improved from 15% to 20%. So to me, that indicates that, well, since the business has issued new shares to open the new branch, that has resulted in a situation that they are more profitable, or they are getting more return on the capital that they employ to carry out their mission. So my answer here was financial gearing of Castro Limited has improved as debt equity ratio improved from 0.8 to 0.5 is to 1. The company has a capital structure that is relatively conservative, obviously relative to the previous year. And then my second quote, because the first quote I made was actually on the debt equity ratio. Then my second quote is on return on total capital employed. So I said return on total capital employed, or ROTCE, has improved from 15% to 20. And to us, it indicates that the new branch that was opened using the proceeds from the shares is more efficient and is more profitable. And it has thus gave us a bigger return on our capital than in the previous year. Cool. And then moving on to question 4.3.3. So they say Henry had the option to buy some of the new shares issued by Castro Limited. He had sufficient funds at interest rate of 5% per annum. for this purpose. They say if Henry wanted to retain his shares, his 60% shareholding in the company, how many shares would he have to buy, and how much would he have to pay? So this is a double question. So the first thing that you want to answer is how many shares did he need to buy of those 200,000 new shares that were issued, and then once you find that, then how much would he have had to pay for those shares in order to obtain the same shareholding of 60%. So let us also go into the additional information again. So we know that Henry owns 300,000 shares in Castro. So in 2016, when he owned 300,000 shares, he owned 60% of the company, because 3/5 multiplied by 100, that gives you 60%. So he owned 60% of the shares. And then in 2017, since he didn't buy, so we're going to assume that he didn't buy the shares, it remained 300,000 throughout. He actually now owns less than 50% of the company. So if the company had 500,000 shares at the beginning of the year and issued 200,000 new shares, if he wanted to maintain his 60% shareholding, he just had to buy 60% of the new shares. The new shares that were issued were 200,000. So you just simply say 200,000 multiplied by 60%, and you would get 120,000 shares, which is what he should have bought in order to be able to maintain his 60% shareholding in the company. And the amount you would have to pay is, you just have to multiply the number of shares he would have bought by 910, and that would give you 1,092,000. So that is quite a straightforward question, easy marks right there. Make sure you get it when you're in the final exam. And then the second part to the question 4.3, they say Henry decided not to buy these shares. Apart from the percentage shareholding, explain 2 reasons why he has made a mistake by not taking this option. So the first mistake that I thought of when I was dealing with this question. So the first thing is that he is earning 5% interest on the money that he has. So he has money, bank savings, and he's earning 5% interest on them. But the return on shareholders' equity is 23%. So he's keeping 5% from the bank, but he's actually sacrificing 23%. So that's like a difference of 18% that he's missing out on as a result of not investing in the new shares of the company. So that is the first thing that I would have said, that okay, he's missing out on a return of 23% for a 5% return on bank savings. Secondly, the shares in the JSE are trading at 12 Rand. So he could have literally bought the shares for 910 and then go sell them at the JSE for 12 Rand, and he would make a profit of more than 30%. And he's keeping the money that's only getting 5%. So those are the 2 key things that I picked up from him not actually buying the new shares. The other thing that I would have said, but I just needed to put 2 points in. So he had a 60% shareholding, right? So he was the majority shareholder. Most of the decision he would just vote, and then that decision would go. But now, after the new shares were issued, he's no longer a majority shareholder. So his decisions can be contested, and he can be overruled by the rest of the other shareholders. So that's the disadvantage now that he is at. But let's look at the answer that I put. So I said he would have paid 910 to buy the shares, obviously, and then go sell them in the JSE for 12 Rand per share and make a profit of 32%. This is versus the 5% bank savings rate that he's currently getting. And then the second reason, he's missing out on the return on shareholders' equity of 23% for 5% interest on bank savings. So those are the 2 mistakes that I think that he is making by not taking up the option of buying more shares. Cool. And then we're done with 4.3.3, and then we go to 4.3.4. This one is much more based on Ronki Limited. So we're going to be looking at the other side of additional information. So the first question there, it says comment on the liquidity of Ronki Limited, quote 2 financial indicators. So you can see, for instance, that the first question in here was actually saying comment. There's nothing wrong with the comment. You just have to show that you understand your comment by expatiating a bit on it. They're also saying comment here, and whatever comment that you put, if you're able to support it, you are going to get the marks. So please, guys, make sure that you try and answer these questions as much as you possibly can, and make sure that you do quote the ratios that you're reading on. So now they're saying we must comment on the liquidity of Ronki Limited and quote 2 financial indicators. So liquidity ratios, you know, the 2 main liquidity ratios is current ratio and asset test ratio. And then other ratios include the average collection period, the average payment period to creditors, stock turnover rate, average days of holding stock. So those are the other ratios. And then in this example here, we've been given about 3 ratios for liquidity. So you can see there that the current ratio went from 3.5:1 to 1.9:1. The asset test ratio went from 1.7:1 to 1.1:1. And then the stock holding period has remained the same, 54 days in each of the years. So in order to answer this question, I'll answer it in both perspectives. So the first perspective, I will say that my comment on the liquidity of Ronki Limited is that it has showed a lack of improvement from the previous period. So I'll say it has showed a lack of improvement from the previous year. That's my comment. And then after that, I'm going to support myself. The current ratio went from 3.5 to 1.9:1. The asset test ratio decreased from 1.7 is to 1 to 1.1:1. So that is my first stance that I would take. But the stance that I took when I was answering the question, I actually said the liquidity of Ronki Limited is actually in a more efficient state that is in. It went from 3.5:1 to 1.9:1. The norm is typically 2:1. So it is not really that far. And to me, it also shows that they're being more efficient with trading stock. They're not keeping too much stock on hand, because when you keep too much stock on hand, you face a lot of risk, like theft, stock being damaged. You have to pay insurance cost. Stock goes out of fashion. So there's just a lot of risk to holding a lot of stock. So if you're able to keep your current ratio at a minimum, but still be able to sort out the liabilities in the short term, I'm happy with that. And then I said the asset test ratio as well, it decreased from 1.7:1 to 1.1:1. The norm is 1:1, and to me it indicates that they have a better management of debtors. So if debtors, so every business wants the debtors to pay as early as possible, because having debtors can be quite a disadvantage at times, because they might not pay back. You know, there can be all kinds of trouble that they end up not paying you back. So if you're able to minimize the debtors that you have and maximize your cash, that is the best case scenario that you can have. So let's just read through my answer there. So I said, the liquidity of Ronki Limited is in a good condition. They are able to meet short-term liabilities. Liquidity ratios appear to be more efficient. And then I said the current ratio decreased from 3.5:1 to 1.9:1, which indicates that they are holding less amount of stock on hand. And then I also quoted the asset test ratio, and I said it decreased from 1.7:1 to 1.1:1, which indicates that the business is more efficient when dealing with debtors. And then we move on to the next question, 4.3.5. They say comment on the price paid by Ronki Limited for the repurchase of buyback shares. You see, again, guys, this is a comment. There's nothing wrong with the comment. The only thing wrong with the comment is not being able to support it. So, they gave you here that the price paid for the repurchase of shares is 15 Rand. But these shares, their average issue price was 10 Rand 20. So what you can say, for instance, is that you can say, well, the company paid too much because they paid shareholders 10 Rand 20. They paid 10 Rand 20. They paid shareholders 15 Rand for the stock to buy back stock that shareholders had previously bought at 10 Rand 20. So that could be argument. My argument in this case, I felt that they did pretty well by paying 15 Rand. It entices shareholders to sell because shareholders have to agree to the buyback. So the company cannot just request to buy back shares. The shareholder also has to agree. So in order for shareholders to agree, you have to offer them a good price that they will be willing to agree. And I thought that it was a fair price because this is also the price that the shares are being traded in the JSE. So if the shareholder wanted to sell the shares in the JSE and you're also offering to buy them back, and you're offering them 10 Rand 20, and in the JSE they can sell them for 15 Rand, they're just gonna go and sell those shares in the JSE. So that's how it would work out. And it's just a little bit above the NAV. So it's good to entice shareholders in order to actually give up their shares and get their money back. So this was my answer. So I said the company bought back shares at a price of 15 Rand, which is above the average issue price of 10 Rand 20 to entice shareholders. This is a fair price if the market value of the shares in the JSE is also 15 Rand. So that was a simple price. And then lastly, with our last question here, 4.3.6, they say explain 3 ways in which Henry has benefited from the repurchases of the shares by Ronki Limited. All right, let's see if we can find some ratios in order to make our explanation more robust. So if you look at 2016, so let's start with the number of shares issued. So if you look at 2016, we know that Henry owns 300,000 shares, and he did not resell his shares when it was a buyback. So he owned 300,000 of the 900,000 shares. That is about 33.3% ownership of Ronki Limited. But now that Ronki Limited has bought back some of their shares, now he owns 300,000 of 580,000 shares. So now it means that he is now the majority shareholder of Ronki Limited. So that is the first benefit for not reselling. The second benefit is, let us look at what these shares are actually returning to him. So you can quote the return on shareholders' equity, for example. Now that they have lesser equity, it's returning more. So he's getting, as a result of this buyback, the return on shareholders' equity has actually improved to 16% versus 13%. And then the other thing that you want to say is the earnings per share. His shares were earning 171 cents per share in the previous year, but now they are earning 266 cents per share. And then the other thing, the total dividends remained the same in both years, but in the other year, he owned 33% of the company, and now he owns 50% of the company. So in the other year, he would have probably got somewhere around 310,000 of this dividend, but now he's probably getting around 460,000 of this dividend because he is now a bigger shareholder in the company. And then the dividends per share as well, you can see the dividends per share went from 103 cents to 160 cents per share. So that's been the benefit of having lesser shares in issue. And so now there's lesser shareholders sharing the pie. So that's how he has benefited. And this is my answer. Point 1, he became the majority shareholder, owning 51.7% of the company. Calculated that by saying 300,000 divided by 580,000. And he previously owned 33.33% of the company. Calculated that by dividing 300,000, by taking 300,000 and dividing by 900,000. And then the second point, as a result of the repurchase of shares, his earnings per share have improved from 171 cents per share to 266 cents per share. And then thirdly, as a result of the repurchase of shares, his dividends per share have improved from 103 cents per share to 160 cents per share. And the other points as well could have been valid, but I decided to go with these ones. So also, there's usually more answers than the required. So just make sure that you pick the points that you think are the most strong and the ones that you are able to articulate well, so that you can get the best possible marks. Okay, guys, thank you for joining. Let us chat in the next video. Cheers. Peace.